Okay, so Amkor just proved that when you are the literal bottleneck for the world's AI chips, you basically, you don't really get an off-season. Welcome to Earnings Unscripted. It is April 27th, 2026, and we are looking at Q1 results for Amkor, ticker AMKR. And honestly, they just beat revenue expectations by almost 10%. So what is your gut take, Miro?
My gut is it is a solid beat, structurally speaking. They brought in $1.685 billion in revenue. And yes, that is down about 11% from the fourth quarter, but you expect that with standard smartphone seasonality. Year over year, though, it is a 27% jump, a record first quarter. Actually, sorry, hold on. We should probably do the legal disclaimer before we go any deeper.
All right, good catch. Very quick reminder that this is just our personal opinion, definitely not financial advice. Don't base your life savings on us. But anyway, you were saying Wall Street obviously didn't love this report given the stock reaction today.
Yeah, not at all. The stock was essentially flat all quarter with some pretty violent swings, but today it just faded, drifted lower into the close, and then post-market, it was a choppy mess. It ended up selling off about 8.7% in the extended session, dropped down near $71. Investors are clearly sweating the profitability squeeze.
I mean, it is visible, right? Net income was roughly $83 million. Earnings were 33 cents a share, down from 69 cents sequentially. Operating margin took a real hit, dropping down to 6%. But the thing I don't totally get is gross margins actually beat their top-end guidance. They held at 14.2%. That feels incredibly resilient for a quarter where they supposedly had material shortages.
Right. Well, those shortages were actually pretty severe. The CEO said they had to push out $50 to $100 million of potential Q1 revenue because certain advanced silicon or memory modules were delayed coming in from customers.
Okay, so the delay wasn't Amkor's packaging lines. The clients literally just didn't have the pieces to hand over.
Exactly. But here's the fascinating part, and it shows why their scale matters right now. The AI backlog is so overwhelmingly huge that Amkor is just playing factory floor Tetris. The CEO called it nonlinear loading.
Wait, how does that actually work in practice?
So if client A doesn't have their substrates ready on Tuesday, Amkor doesn't halt the line and eat the downtime. They just immediately swap in client B's components from the backlog. They plug the gap so fast that overall factory utilization stayed steady in the low 70s.
Wow, it really pays to be the indispensable middleman. Demand is basically a solid wall, and if one brick falls out, another just drops right into its place.
Yeah, it is a very powerful position to be in, but it comes with its own costs down the line.
All right, well, we know that leverage is about to get seriously tested, especially since they're spending a fortune building out this massive new U.S. hub in Arizona. Let us get into the details on those margins.
Yeah, the Arizona hub is exactly the anchor here. Look, building a localized supply chain from scratch is not cheap. Management actually put a number on the pain this quarter. The CFO, Megan Faust, explicitly warned they anticipate this will start to dilute operating income margin by approximately 1% to 2%, beginning in 2027.
Wait, so they take a guaranteed 2% hit just to open the doors? That is all hiring and training before a single chip actually rolls off the line.
Right. It is pure drag. You have to hire the engineers, you train the staff, spin up the utilities. All of that operating expense hits the books way before the revenue does. I mean, I think people look at the total CapEx. They're targeting roughly 2.5 to 3 billion for the year, and they assume the cash flow impact is smooth, but it is not.
Okay, but looking at their free cash flow, it was negative $79.5 million, which honestly is, I think, not as bad as I expected for a $3 billion spend year. Did they just underinvest this quarter?
No, they're just delaying the pain. Actually, I was going to say this is a classic accounting illusion. Cash paid for capital expenditures was only about $225 million, but they had a $200 million jump in CapEx payables.
Oh, okay, so they bought the equipment, they just have not paid the invoice yet.
Exactly. The invoices are literally sitting on the desk. So that free cash flow number is artificially buoyed right now. The heavy outflow is weighted to the back half. Something like 70% of the spend is coming in the second half of the year. But they do have a massive safety net.
Right, the government money. The 10K mentioned that new One Big Beautiful Bill Act, the OBBA, right? It bumps the CHIPS Act tax credit from 25 up to 35%. And combining that with their $400 million grant?
$2.8 billion.
Wow.
Yeah. That is the total government support they are expecting. That basically de-risks the entire Arizona build-out.
$2.8 billion. Geez. Okay, so that explains why they had the confidence to authorize a new $300 million share buyback. I was reading that and thinking, how on earth are you buying back stock when you are dropping $3 billion on a factory? But the government is effectively floating the factory.
It is a very comfortable position to be in. But look, the domestic story is just one side of their margin dynamics. What I actually found much more revealing was, well, how they are handling raw material inflation right now.
Oh, the Middle East geopolitical stuff.
Yes. Gold, precious metals, substrate materials, things they made for advanced wiring, prices are spiking. Normally, an OSAT company like Amkor just has to eat that cost, or at least share it, and margins get compressed. But not in this cycle.
Because everybody is so desperate for AI capacity.
You got it. The CEO said it perfectly. He noted they're working closely with customers to offset the cost increases. The demand is so inelastic right now that Amkor just hands the inflated bill to the customer.
And the customers are willing to pay it. The CFO called it a highly constructive pricing environment.
Constructive pricing environment. I love how finance speak just strips the violence out of it. They are literally just forcing price hikes down their clients' throats because no one else can package these chips.
Well, the power dynamic has shifted. When you hold the keys to the final assembly of high-density fan-out chips, you do not absorb macro shocks. You pass them on.
It is a brilliant hedge against inflation, honestly.
So they are protected by government cash on the capital side and protected by absolute sheer desperation on the pricing side. I guess the big question then is, how long does that desperation actually last? Where does this leave them heading into next quarter?
Well, the immediate answer is it leaves them looking surprisingly solid for Q2. Management is guiding revenue to roughly $1.8 billion at the midpoint, so up about 7% sequentially.
Wait, but that goes totally against normal seasonality, right?
It does. And the interesting thing is, it is not even just the AI side doing the heavy lifting. The CFO specifically noted that communications revenue is expected to be stronger than seasonal, mostly driven by continued strength in the iOS ecosystem.
Okay, so Apple is basically holding the line while the big AI chips ramp up.
Exactly, because the CEO stated their newest data center CPU program is expected to begin ramping this quarter, but the meaningful revenue bump from that does not actually hit until the third quarter. It is a very well-timed bridge.
Right. Assuming the materials actually arrives, because that is my lingering red flag here. If they just pushed out up to $100 million this quarter because parts were missing, are we just going to see a rolling delay every 3 months?
That is the central risk. At some point, being flexible on the factory floor is not enough. You actually need the physical substrates to show up, or your revenue velocity just hits a hard ceiling.
Yeah, that makes sense.
And if you layer on a broader macro slowdown, let us say automotive demand craters out. You might suddenly discover those ironclad backlog orders were not quite as guaranteed as management thought.
Right. The classic double honoring illusion. So incredible pricing leverage today, but gravity might eventually catch up to their supply chain.
Gravity always wins, even in semiconductors.
Fair enough. Well, we will definitely be watching that massive capital spend hit the books in the back half of the year to see if the math still works. But I think we leave it there for today. Before we head out, if you want these earnings drafts to just show it for you, go ahead and follow the podcast. And just a quick reminder that this is an AI-assisted show, which basically means we use models to parse the heavy filings so we can focus on the narrative. We'd love to know what tickers you want to hear next. So drop us an email at earningsunscripted@datamadness.ca or catch the X link in the show notes. Talk soon.
Take care.